Hello, everyone. Hello. Welcome. I'm so excited to be here today. Just to introduce myself real quick, my name is Alaina Fingal. I am a certified financial coach. I'm an author. I'm a content creator. I have a YouTube channel, and I talk about three critical areas that I believe lead to financial success. And we are going to dive into those areas today. That's the main thing that I wanted to discuss with you today. Um, and the very first area that I wanted to talk about is actually life organization. Life organization is something that I talk about in areas of planning and figuring out how you're going to structure your day and knowing your own behavior. And a lot of times when I talk about these things, people don't see the correlation between money and having your life be organized or having a system to your life. And the main thing that I realized in my entire history of dealing with money is that the statistic of personal finance being 80% of behavior is definitely true. And it's impossible to know how you are with money unless you know yourself and you know your behavior and you know your personality and you know your history of what you were taught when you were young and how your family has dealt with money, and you're able to deal with those particular things. So I dive into something called the 5 money personalities, which is based on a book by Bethany and Scott Palmer. And there are 5 money personalities that each one of us have. We have one of these personalities, and it's just like you have a spiritual gift and you have a love language, you have a money personality. There are 5 of them, and I wanted to give them to you really quick just so you can kind of see if you can identify who you are in them. The very first one is the saver. The money personality of the saver is a person who absolutely enjoys saving money. You love to see it growing in your bank account. You love to see that number getting bigger and bigger. And knowing who you are is tied to how much you're able to save. It brings you ultimate joy in order to have a high number in your bank balance. The second one is the spender, who is the opposite. You purely enjoy spending money, going to the mall, finding new things, the quality, the look, the browsing, all of that gives you ultimate joy. You are the type of person that loves to spend on yourself and maybe even other people. It's the act of actually spending money that gives you joy. The third one is the risk taker. This is the person, this is usually the business owner, the person that likes to take $1 and make it $3. As soon as I get paid, I want to know, how can I double my money? How can I triple my money? What could I invest in? What's the real estate market looking like? They are the type of person that likes to take $1 and make it 3. They are really consumed with the risk of it all, and the risk actually excites them. It makes them have pure joy. The next one is the security seeker, and that is who I am. It's the person that doesn't mind spending, but they love to have a plan. Everything is planned out. If they're going on vacation, they want to plan everywhere they're going to go, how much they're going to spend. They want to have a budget. They want to have everything planned out. And it gives them joy when everything goes according to plan, meaning that when they see how everything is kind of laid out and it's all according to how they have decided it's going to happen, then that's when they have joy and they get pure security from their money, meaning that everything is laid out the way it's supposed to happen. And when it does happen that way, they have a sense of security and they are happy. And the last one is the flyer. This is the person that's not moved by money at all, meaning that they don't have a tendency to make decisions based on their money, based on how their money is going to, move or do anything. They don't take jobs based on the pay. They only do things based on their happiness, based on their family. It's based on other things. But those are the 5 money personalities. That's kind of where we start. That's kind of like the area where I will start, because knowing that will help you with things like impulsive shopping. It will help you with overspending. It will help you with the fear of losing money. It will help you identify other things that you may not even realize it's going on with you and your behavior when it comes down to money. You can also have a primary and a secondary money personality. And this is how we have things like buyer's remorse. If you've ever gone into the store and bought a bunch of stuff and then regretted it as soon as you got to the parking lot, that's usually 2 money personalities that are clashing together. But knowing who you are is the very first part of identifying how you're going to handle money. Knowing your personality, your behavior, knowing yourself, and being able to identify who you are. And if you're married, even your partner, who they are when it comes down to money, is the very first thing that you need to do. The second area is actually managing your money. Managing your money. This, when it comes down to budgeting, saving, paying down debt, all of this revolves around consistency. And it's one thing that I teach on my channel is how to be consistent. When we are talking about things like working out, we all know that we can't work out once and lose 10 pounds, right? We all know that. We have that concept pretty locked down. But when it comes down to budgeting, most people feel like, well, I tried that budget one time. I tried this once or twice and it didn't work for me. So then I just can't make it work. It's all about showing up every single day and being consistent with what you have decided to do, being consistent with your budgeting, being consistent with saving, being consistent with figuring out your strategy and how you're going to pay down debt. A lot of times I will look at budgeting mistakes, like we'll dive into the 10 budgeting mistakes that most people make, because when we think of budgeting, we usually think of one track mind. We only are thinking about one particular thing. And if that way doesn't work, then all of a sudden we feel like we're not good at it. If we can't save $250 every single check, then I'm just not good at it. But in reality, you just have to find a system that works for you. You have to find a strategy that works for you. And that's what the organized money is all about. We are looking at strategies, we're looking at systems, we're diving into the consistency of it all and making sure that you're staying consistent. Every single Monday, I teach a class on Zoom, and it's actually a free class, and it's a financial literacy class in order to revolve just around money. And we have talked about things like how to get 1 month ahead on your bills and the top 10 budgeting mistakes. And the reason why I have decided to dive into financial literacy classes every single week is because financial literacy is how we overcome a lot of our fears when it comes down to money. It is the one way to combat the fear of not having enough or not knowing enough. And that's actually learning. So if anyone's interested, you can find out more about it on my Instagram page. But every single Monday, we're talking about financial literacy. And I always encourage people to read financial literacy at least once a day, once a week, where you're diving into a topic so that you can continue to learn. And the more you learn about it, the less frightening it will be. And the third area, and probably my favorite area now, is monetizing what you know. And that is, that's something new that I just started with the Organized Money, is teaching this. And that is because the 2020 COVID-19 pandemic was a health pandemic for us all. We have seen the effects, and we're still feeling it, of how it has held the nation back health-wise. But a lot of things that we don't talk about, or some people are seeing, is the financial crisis that it is causing. And during that entire thing, when it first hit around March, I realized that having one source of income was not going to be, was such a huge thing if you only had one source. If you had one source and you did not have multiple sources, you really suffered during the COVID-19 pandemic. So I have always, because I'm self-employed and because this is the only thing I do, I've always had multiple streams just for my own security. But I realized how important it was to teach everyone else about having multiple sources, using the gifts that God gave you and being able to multiply that and do different things. So I graduated in accounting. That's my first source. But then I took that same knowledge that I had in accounting and I put it on YouTube and be able to monetize my YouTube channel. I, do group coaching so that I'm able to have a source under group coaching. I help businesses, and I'm, the CFO of different businesses, small businesses, so that I can have a source of income there. So I started teaching other people how to create sources of income around what they already have, probably what they're already doing in their 9 to 5, and be able to take that thing and multiply it across the board. So those are the 3 areas that I believe that if you have them, you are able to really, really achieve your financial goals. And those are the 3 critical areas that really revolve around financial success. And I put out content for 5 days out of the week, Monday through Friday, around these 3 topics. And I believe that the structure of saving money, the structure of knowing who you are, it will help you with saving and being able to be better with life, managing life. And then the system of managing it and the security of making more of it is how you actually get to the next level. So it's not like once you're one, that's it. And you think of it like, your love language or your spiritual gift. You can be one, have a secondary one. You could have a little bit of another one, and you can be different things in different seasons of your life too. Like when I was smaller, I was probably way more of a saver, just wanted to save money. But once I had kids, it kind of changed and I became more of a planner and a security seeker. So, and then who you're married to makes a difference too. So there's so many different things that can kind of happen, but knowing who you are with your money, even I have a test on my website where you can take the test and try and figure out, but knowing, even if you know that, okay, I modulate between these 3, that will help you make money decisions. That will help you, okay, if I plan this out and then I can save this and I can do this, all 3 of my money personalities will be happy at the same time. And that's the point, is to help you modify your behavior around your personality.
Thank you all so much for having me. I am going to share my screen. I put together a little PowerPoint for y'all because I am an S personality type, a little like Alaina. I'm very structured and like planning. So can y'all see this okay?
Yes.
Perfect. So like she was saying, my name is Kenzie Symone. That is my social media handle on most all social media, so make sure that you follow me. So a little bit about me. Who am I? I'm a Christian. I'm a daughter of 2 of the most phenomenal people I've ever met. I'm a sister, the youngest of 4 girls. I'm a friend, a girlfriend, a 2019 graduate of the best university that there is, the University of Miami. I'm also a YouTuber and a millennial financial services agent. So how it all started. My dad is from Germantown, Pennsylvania, Philadelphia. He grew up in a single parent household in a row house. This is actually a picture of it. And he, by trade, is an accountant, a CPA. And my mom grew up in Dothan, Alabama. Her mom had a 3rd grade education. Her dad had an 8th grade education. She went on to get her MBA from Howard University, and she was a manager at Bell South. But, my parents both kind of were in that rat race of living paycheck to paycheck, not really being able to achieve all out of life that they wanted. So they decided to make a change. And that's kind of where we are now. This is a picture of our home that we currently live in. This is what we call the palace, or our office. We're not here too much because, hashtag Corona. But this is our office, one of them. And then this is our vacation home in a gated community. That's me on our speedboat. So my parents have really been able to, not only show my sisters and I a different path of life, but also they're teaching others to do the same. So these are the Phillips. This is Phillips gang. And then these are a few of our associates. So a little bit about us. Phillips and Associates has been in business for the last 40 years and counting. My parents obviously have ownership. They're not self-employed. They are business owners. We have 25 different locations all throughout the United States, and we specialize in life insurance, investments, college savings, and retirement planning. So someone, a legend, a man, the myth, business owner, Nipsey Hussle himself, in his lyrics said, $1 million life insurance on my flesh. So I want to talk to y'all a little bit about life insurance and kind of your last love letter. A lot of times people don't realize that life insurance is actually the easiest way to create generational wealth from scratch because it is a tax-free event. So I know a lot of times people are like, wait a second, do I got to get $1 million on my flesh? How much do I need? So we like to go through an exercise called the dime, and we like to look at 4 different categories that most people, are financial categories in your life. So the first D and dime stands for debt. Any outstanding debt that you have that might translate over maybe to your kids, maybe to your spouse, car notes, credit card bills, medical bills, anything like that. And then we also like to look at final expenses. So do you want to be cremated? Do you want to have a funeral? Those things really start to add up. The most expensive funeral that I've seen to date was $25,000 just to be put away. So that's definitely a huge expense. But we also want to look at life after the funeral. How is your spouse or your children going to be able to survive if your income isn't coming in anymore? So when we pass away, our income passes away with us, but the bills continue to come. So how are we going to replace that? The third area is a mortgage. If you have a mortgage that you're paying on, and like I said, if you're using 2 different incomes to pay on the mortgage and one of those incomes stops, what happens to the home? And then the last area is education. If you have any young kids and education is important to you, college education, trade school, any of that, how much money do you want to leave? Do you want to be able to pay them off in full? Do you want to make a contribution? So these are the 4 different areas that we look at when it comes to deciding on your life insurance amount. So now you're probably thinking, okay, that's cool, Kens, but I already have life insurance on my job. So I'm going to tell y'all 3 different reasons as to why you need it outside of your job. The first reason is because you are not the owner of that policy, your employer is, which means that they're able to make any changes to that policy without consulting with you. So, if you look at the certificate that your employer gave you in regards to your life insurance, it's a life insurance certificate and not a policy, and that's because you're not the owner. The second reason is because whether you tell your boss you're fired or your boss says that to you, that life insurance doesn't go with you. So you always want to make sure that you're in control of your own policy outside of your job. And then the last reason is because of insurability. Now, while you're young and while you're healthy, you want to make sure that you go ahead and get some life insurance due to the simple fact that, if I'm getting a little personal here, my dad had his first heart attack at 39 years old and became uninsurable. And his mom became uninsurable at the age of 27. At 27 and at 39, you never think that you want to be able to be insured anymore because life insurance is nothing more than a contract. and the insurance company is taking on that risk. So there is, to make sure that you can be actually insured. So now we're going to talk a little bit about the main two different types of life insurance. So the first type is a cash value life insurance policy, otherwise known as whole life, universal life, index universal life, variable universal life. Those are all different types of cash value life insurance. So say that we have this example of Barack and Michelle, both at age 35, and they have this cash value life insurance for $100,000 on each of them. That monthly premium, if they're young and healthy at age 35, is going to be about $225. And the reason is because part of that money is going to go into the face amount and the other part's going to go into that cash value. And if we look 30 years down the line, that cash value would have grown to a little over $75,000. So you're probably saying, that sounds great. Sign me up. That's exactly what I need, life insurance and cash value. Heck yes. But now I want to talk to you a little bit about why not cash value. So if you have a $100,000 face amount and your cash value grows, kind of like in the policy, to around $75,000. And remember, the premiums are always more expensive because part of your premium is going into the face amount, the other part's going into the cash value. If you were to pass away here, how much money should the insurance company leave your family a check for? Think about that for a second. Most people typically would say $175,000, but they'll actually only give your family a check for $100,000. So most people typically say, what the heck, where is my cash? The number one reason that you do not want to have a cash value policy is because you lose your own money. The second reason is because the Federal Trade Commissioner says that your money is going to grow inside that policy, typically anywhere between 1% and 2%. And at that point, it's probably a little bit better to just go ahead and keep your money in the bank. And then the last reason is because any money that you do take out, they say you can take it out and use it as the down payment on a house. You can go on a dream vacation, put your kids through college with that money. But you have to pay all of that money back that you take out of your cash value plus interest. And interest is typically anywhere between 6 and 8%. So if not that, then what? I want to share a quick clip by one of my favorite people, Susie Orman, which is also Oprah Winfrey's financial advisor.
Now a video cue. Let's go to Catherine in Salt Lake City, Utah.
Good evening, Susie. I'm married with 2 young children. Our financial advisor signed us up for variable life insurance on my husband. We pay over $600 a month with a death benefit of $750,000. We've had it for 6 years, and I've never felt comfortable about it, and I'm wondering what we should do.
What you should do, first of all, is get yourself a new financial advisor. That's number one. Miss Orman here has a top 10 hate list of investments that she hates. And she hates them because they literally do absolutely nothing for you, and they do everything, in my opinion, for the financial salesperson that sold them to you. And variable life, universal life, whole life insurance, that's probably on the top of Miss Orman here's top hate list. So the only type of life insurance that you should have, in my opinion, is term insurance. Insurance that's good for a specific period, a term, usually until your youngest child is 23 years of age. $650 a month for $750,000 of insurance. Do you know, with a 20-year level term policy, let's say you were in your 30s, you could do that for $50 a month. Not $650 a month. And then you could take that $600 and do what with it? Put it into a retirement account. Insurance was never meant to be a permanent need. It was only meant to be there during your younger years in case something happened before your assets built up. Here's what you need to do. I want you to get yourself a 20-year term insurance policy in place. Then cancel your other insurance. Never, ever, ever cancel insurance until the new one is in place. And like I said, get another financial advisor. All right.
So I love Miss Susie because she is so feisty, just like me. But I am going to go ahead and wrap up with just a little more. So, like Susie was saying, life insurance was never meant to be a permanent thing. It's meant to be there in your younger years until you build up that actual liquid cash. So, if we're looking back at Michelle and Barack again, same age, 35, and we're using that same $225 a month. If we put a life insurance policy on each of them for $250,000, y'all, that's $500,000 within their estate. Their monthly premium will be right around $80 a month. So if we take the difference between that same $225 and that $80 a month premium, so which is $145, and we put that into an interest-bearing account, by the time 30 years is up at the end of their term at age 65, they would have had more than $250,000 in their estate, liquid cash that they can use and don't have to pay back. So I want to wrap up with something called the Rule of 72, which is also known as the banker's rule. And basically what the Rule of 72 does is it tells you how long it's going to take for your money to double. And the way that you get this is just by dividing the number 72 into whatever the interest rate is. So if we're looking at 3%, if we drop a lump sum of $10,000 into an account that's bearing 3% interest, it's going to take your money 24 years to turn into $20,000. And by 48 years, you'll have $40,000. Now, like we were just talking about, we're all here just on borrowed time. So who got 48 years to be putting their money into something with 3%? So if we look at something like 6%, that means that your money is going to be doubling every 12 years. That's pretty good, right? At the end of 48 years, you'll have $160,000. But we always want better. So if we look at something like 12%, that means your money is going to be doubling like clockwork every 6 years. Can y'all guess how much money you'll have at the end of 48 years? At 12%? $2,560,000 cash in your account. So y'all, that is basically what we do. We teach people the importance of buying term insurance and investing the difference, and also building a recession-proof business, basically teaching people the importance of, leaving a legacy to your family, and also building a legacy for your family and having ownership, of your own business. So thank y'all so much. I'd love to connect with you. These are my social media handles. On Mondays, like I said, I do have a YouTube channel. On Mondays, I have a segment called Money Mondays where I do different talks about this. And yeah, I'd love to connect. Thanks so much for having me. Every person is different. It depends on what your financial goals are, how much money you're living off of right now. People typically retire at about 80% of their income. So we like to just sit down with each family differently and kind of see what your needs are to be able to tell you, hey, yes, what you have right now is perfect for, what your desires are. Or, hey, maybe we should look at something that's a little more aggressive or a little more beneficial for your family.
Perfect. So I'm actually going to expound on credit card hacking and retirement accounts. So I am Candace McGee. Again, I am at Millennial Financial Educator on Instagram. I am a money coach, and I teach millennials and Gen Z how to treat their dollars like reliable employees, and also how to use their finances to build a life that they love. So what I'm going to do is just pretty much go right into the first subject for credit card hacking. I'm going to share my screen with you guys. So, all right, so the first subject of credit card hacking. So before I tell people how to credit card hack, I like to preface that conversation with a couple of things that we should keep in mind before we start doing that. You guys can feel free to take pictures, screenshots of anything that you see here. The first thing that I tell my clients is to never apply to credit card solicitations. The reason for that is because if you're being approached by a credit card company for a specific card, it's not going to be the best credit card for your wallet. So the good news is that if you're getting those in the mail, it means that your credit is good to excellent. So if you've been working on repairing your credit, this is a good sign that you're on the right track. They are still a nuisance to receive in the mail, at least in my experience. So if you want to opt out of that, you can go to the website that is listed there on the slide to do that. That is a credible website that's run by the 3 bureaus, so your information is safe there. The next thing that I like to tell people is that credit cards are designed to keep you in debt forever. So this is something that you need to keep in mind if you want to get into credit card hacking. And the reason why credit cards are designed that way is if you think about if you try to go get a mortgage and your credit is not good, or if you don't pay your mortgage and you default on that loan, the bank will take that house and flip it basically to try to recoup some of the money that they lost in the deal with you. With credit cards, that's not the case. If you use it to pay for furniture, vacations, groceries, or whatever, the bank cannot come back to take those things from you. So they charge higher interest rates. So at the end of this, if you continue to keep accruing credit card debt, you're continuing to pay for things that you don't even remember that you purchased, or things that you may not even have anymore. And the last thing I like to say is that you should never charge what you haven't budgeted for. So I hear a lot of people say, don't charge it if you don't have the cash to pay for it. I like to take it a step further. Just because I have the cash sitting in an account doesn't mean that I should take it and blow on something that maybe I didn't plan to buy, that I did not budget for, but I know I have other expenses coming up that are much more important than that. So after understanding those three things and you have your good foundation for your finances together, then you can start moving into credit card hacking. So what does it look like? People say it all the time. I use my credit card to pay for travel. How does it work? So this is a real life example of a card that I have, the Chase Sapphire Reserve. It is my favorite card. It is good for people who prioritize travel. So if you say have young children and maybe you don't do a lot of traveling, but you prioritize groceries or gas, there's a different card that's better for you. So for me, I have to pay the bank $550 every year to use this credit card. And I get asked all the time, is it worth it? That's a lot of money. So here's the way I see how hacking this credit card makes sense for my life. So if I start out with $550 a year, every year, Chase gives me a $300 travel credit. So I can use it to pay for plane tickets, Lyft rides, hotels, anything travel related every year. So to me, each year, that means that my annual fee for this credit card is now actually only $250. Okay, so even still at $250, is it worth it? If we move over to the left side of the slide, if I spend on travel or dining, I get 3 points for every dollar that I spend. So if I live in Atlanta, so if I go to downtown Atlanta and spend $10 on parking, I'm going to get 30 points. And I pulled up my last statement actually for this example about the Lyft rides. So Chase has a partnership with Lyft where they say, okay, you know what, our card members will get 10 points for every dollar that they spend on Lyft rides. So my last Lyft ride from the airport was $31.26. Multiply that by 10, that's going to give me 312.6 points. Now that's me. Again, these are things that I already budgeted for. I knew I was traveling. I'm not splurging anything here just for the sake of getting the points. I'm only spending on things that I need in my life. And so over time, since I use my credit cards as a primary payment method, I'm using it to pay for gas, my bills, my groceries, all of that stuff. The points add up. So at the time that I made this presentation, my points between my 3 Chase cards, I have 3, and I combined the points together to redeem them for travel. So I had, at the time I made this, 79,815 points. So if I redeemed all of those points for travel, that at the bottom of the slide is what I would get, $1,197.23. So $1,200 for travel. So to me, I'm getting $1,200 and the year is not over. I'm still going to be accruing points and I'm saving them up for a good vacation post-Rona. But to me, the annual fee of what I look at as $250 is absolutely worth it because of the benefit that I get back from adding up those points. So outside of using the points for travel, you can use them for shopping or you can use them to have cash back in your pocket. But there are some other perks that come with having credit cards as well. And I'm going to show that in the next slide. So this is something that I put on Instagram for why I use credit cards while paying off debt. To be transparent, I do not have any credit card debt. So I feel absolutely fine with hacking my credit cards for my benefit. So this is just a snapshot. It's not all of the perks that come with the credit cards, but I use 4 on a regular basis. And this is some of the things that they come with combined. So the free cell phone insurance, I used to have cell phone insurance with my service provider. I had to pay a premium every month, and the deductible was much higher than $50. So with one of my credit cards, the cell phone insurance is free, and I just pay the $50 deductible, and they will fix the problem or replace the phone altogether. And then this just goes into some other things like some fraud protection, the fact that you're going to be showing the creditors your credit diversification, that you are able to use credit cards and other types of debt responsibly. If there are any disputes that come up, we all know someone, or we've been that person who we've lost our debit card, or there's something crazy going on with our account and we have to wait to get a replacement card, cash, you can't access the money in your account, all that crazy stuff. When you're using a credit card as a primary payment method, as I do, my cash is fine. Anything that happens with Chase's money, that's on them. They will figure that out, but my cash is safe. So that's another form of protection that comes with using credit cards responsibly. And so I'm going to jump from this into moving on to the retirement accounts. Again, as the ladies have said, you can leave your questions and I will get to them. And the last thing on retirement. So I've been getting a lot of questions about this lately. So, I like to tell people that if you have a 9-to-5, your 401k is the easiest way to start investing while taking advantage of tax breaks. So when you are contributing directly from a paycheck to a retirement account of an employer, those contributions are not a part of your taxable income. So that's how you save tax on the front end. It comes out of your out of your gross pay and not your net pay. So you are saving on taxes on the front end. I also like to tell people who have a 401k that they need to understand the employer's contribution match. So if your employer, for example, says, we will match what you contribute into your 401k up to 5%. So you say, okay, I'm going to contribute 5% of my pay to my retirement account. Understand the breakdown. So what the breakdown really may mean is, okay, for the first 3% that you contribute, we will match what you put in your account dollar for dollar. But on that last 2%, we're only going to give you 50 cents on the dollar. So you want to understand the breakdown of what your employer's contribution is, because that can help your decision as far as saying, I'm going to put this much in my 401k, and then I'm going to take this other amount and put it into my own retirement account that I open away from my employer. So I'll talk a little bit more about that in a second. I also tell people, do not settle for the status quo of your 401k. So what a lot of people don't realize is that when you put the money into your retirement account, there's more that you have to do. They typically auto invest into some very safe investments. And if you're young and you have a lot of time to recover, you need to actually go into your account and tell the system where to send your money. I had this conversation with a particular person, a client of mine, who, when the coronavirus pandemic first happened, we were talking about return on investment and how to move the money around. And that was something that she and a lot of other people did not really know about. So make sure that you're educating yourself about where your money is going inside of your retirement accounts. Now, outside of a 401k, you can still open your own traditional IRA and or your own Roth IRA that's separate from your employer. And I do encourage everyone to do that because you have more flexibility over the types of investments that you can choose from. So with a traditional IRA, those contributions are tax deductible. So you're going to be contributing them, say, with your net pay from your employer. But when you go to file your taxes, you can deduct those contributions from your income on your Form 1040. So you still get a tax benefit on the front from having a traditional IRA. The thing to keep in mind about traditional IRAs, though, is that you have RMDs, which is a required minimum distribution. So I'm assuming that no one watching this is getting close to age 72, but this is important to keep in mind for people who are trying to build generational wealth. At the age of 72, the IRS has a requirement that you start taking money out of your IRAs. And this is a way to stop people from trying to play the system and avoid taxes forever. Okay. Now, this requirement was waived by the United States president for 2020 because of what's happening with coronavirus. If your investments have taken a dip, he's giving those people who may be at the age where they have to do this distribution every year, he's giving their accounts a chance to recover. So if you are interested in building generational wealth, you want to think about a Roth IRA that is tax-free growth. So when you contribute to a Roth IRA, there is no tax deduction for that. So when you take the money out later, you don't get taxed on the income the same way that you do with a traditional IRA or with the 401k. There's also no required minimum distribution on that account. So if you wanted to leave that money to an heir and list them as the beneficiary, you can absolutely do that. And they will not have that same requirement to take the money out as they would with a traditional or traditional IRA or 401k. So to kind of wrap this up, if you are eligible for a Roth IRA, I do suggest that you consider it. So there are some income restrictions on most of these accounts for who can contribute and who cannot. And that's going to be based on the IRS rules, which change from year to year. So always check in with them and their law for each year to make sure that you are doing what's best for your situation. A lot of the older people that I've talked to, or seasoned people, I like to call them, they regret not putting more money away for retirement. So I don't really hear people say, I wish I had gotten a higher paying job. I wish I made, I went into a different career field and made more money. They typically say, I wish I had put more money away from retirement. So if we can learn a lesson from other people without having to necessarily go through those pitfalls ourselves, then that's always a great route to take, in my opinion. So definitely look into Roth IRAs. And this last point is that it is a widespread belief that all Roth accounts have these income caps. So this is false. Someone spoke on this earlier. If your employer has a Roth 401k, those do not have the same income caps. So you may make over the IRS threshold, but if your Roth account is housed with an employer, that income cap will not apply. So anybody who has a regular 401k with your employer, check to see if they also have the Roth 401ks. My employer fortunately does have one, and I do contribute to that. So just make sure you're understanding all of the options that are available to you. And at the bottom here, that's my website, my email address, and my handle on Instagram if you want to keep up with me or keep in touch with me. I'm also offering $100 off of my 90-minute intensives if anybody wants to talk about their financial situation and figure out how we can kind of deep dive together to figure out how to change your strategy with your finances. The price is normally $297. I'm knocking it down to $197 for anyone who is a participant of this event today. And that is all that I have that's all that I have to say. So thank you so much for your time and your attention. I am going to turn it back over to the ladies of Good Vybez Tribe to wrap it up. I always start with the very basic budgeting. A lot of people, we don't like that word. We don't want to do it. We don't put ourselves on limits, don't want to put limits around ourselves sometimes, but you have to start very basic with that. I don't really encourage credit card hacking if your credit card debt is out of control, because you wind up, you're not getting the benefit of the card if you're continuing to pay interest. So when I'm working with my clients, we work on kind of, as pretty much the surrounding theme of the conversation today has been your mindset and changing your habits, so that you can make sure that once you get into credit card hacking, that you're doing it guilt-free and you're not putting yourself into a deeper hole, because that's one of the things that the credit card companies are banking on. They have a price on your head that you are going to mismanage and slip into debt. And they know that even if they give you all these lists of benefits that these cards have, it's just like if you get a gym membership and they tell you, you get all these things, you get the sauna and the massages and all that stuff. Realistically, everybody is not going to take full advantage of the benefits that's offered to them. And so that is something that, like I said, the credit card companies, they kind of prey on you to fall into the trap of glorifying credit card hacking. So I deal with more so the behavioral thing and stopping the negative cycles with the credit cards first by dealing with, your money management, basically.